Basant Maheshwari joins us live in a Mumbai studio. No party for you, sir, last night?
No party. We had a good party after Sitaraman gave us that corporate tax cut. So that's bigger than whatever you can have.
I'll show you a graphic. You'll be surprised at how many markets today are trading. Let's see that graphic and then I'll get a reaction on you that should we be open on 1st of Jan. Let's see that graphic, guys. Do you want to guess how many markets are actually trading in the world today?
I think just India and Saudi Arabia. That's what I think.
Yes, that's right.
Yes. You've been watching ET Now to Trendle.
Right.
Or maybe ET Now. Should we trade on 1st of Jan? I think that's a big question. There's a more fundamental question which I want to address today with all guests.
So but let me play the other game round. We get a holiday post Diwali. So you can't have 2 New Year celebrations in a calendar year. And for people like us who are addicted to the markets, when the markets are closed, I mean, it's tough to get the day going. So
oh my God. Can we just erase that back to this?
Okay, fair enough. I didn't count the post Diwali extra day, I guess, but so many times
We trade on Diwali also half a day.
Yeah. That's
we trade
also
on
true.
Diwali also.
Mahura trading, that's also true.
we do that, yeah.
God, we gotta have some break, right? Or a truncated day.
Okay, Basant, let's talk about something which you expertise in. Identifying mega trends and where money is going to be made in this decade. Financials now account for nearly 40% of the weightage. Last time when any sector had this kind of representation on the Nifty, bad news followed us. That happened in 99, 2000, TMT, telecom, media, IT stocks. They had a 40% weightage and then we know what happened. The only fear is that financials today are looking good. They are like this grand mega trend for next 10 years. But pricing and weightage and over ownership is something which in a sense makes me wonder that will the party continue?
Your analysis has already played out. Financials, you said, with a 40% weightage, there has to be breakage in the sector. So from the ILFS days, most of the financials are down 40, 50, 60%. So the analysis has played out. What hasn't played out the way people would have liked it to see was the leaders actually took away all the market share and they're still growing. If all financials collapse, the economy is going to collapse. You cannot have an economy where every bank, so not a recommendation. So if I tell someone, yeah, if you have some extra money, just go and buy HDFC Bank and Kotak Bank. He says, no, sara paisa dal denge. What happens if HDFC Bank, if there's a problem tomorrow? I said, if there's a problem tomorrow, then on your way to HDFC Bank from your house, look left, look right and see which bank is open. Because they are the last ones to come in a problem. So this is what happened. What you're saying is perfectly right. And this theory was going around that financials are 40% of the market. And there has been a breakage in the system. A Yes Bank has lost 1 digit in its price. So from 400, it's come to 40. Look at any other, India Bulls. That's also lost 1 digit. From 1300, the one has gone away. So the destruction normally in the market happens through digits. It doesn't happen in percentages.
It's a great point. So my immediate follow-up question is that let's look at a classic case like Reliance. In 2008, when it had a lot of, between 2005 and 2008, Reliance almost was a multi-bagger, a large cap stock which became a multi-bagger. Between 2009 and 2014, Reliance did not give great returns. It went into, growth was there, the company was growing, they created new verticals, they added Reliance Retail, but yet for shareholders, it went into time-wise correction. So financials will be there. HDFC Bank will grow. EU financials will grow. Bajaj Finance will continue to grow in balance sheet. Disruption has happened and market leaders will survive. That's the theory. But for shareholders, do you think financials or good quality financials now run the risk of getting into time-wise correction?
So let me address this Reliance thing first. Between 2003 to 2008, there was a commodity bull run and Reliance was doing well. The public, the investing public hasn't quite understood the way Reliance Industries would deal with the retail consumer bent. So all this time they were doing gross, dealing with the government and dealing with bulk production of commodities. So if you have a 15-17% growth, then the risk of time correction is always there. But if you have a 30-35% growth is exclusive, it's a rarity. Then the risk of time correction doesn't come through unless the 30% growth falls to 20% growth. Like for example, HDFC Bank used to grow at 30. Then from 30, it came to 28, then to 25,
15,
then to
16,
22, now 18. So over the last 25 years, there has been a growth. There has been the growth has stopped in HDFC Bank by 2-3 percentage points every 4-5 years. But still the stock continues to do well. So it's the way the growth stops. If from 40% suddenly you start growing at 15, then the stock has to fall 40%. So, but I don't think that kind of an event is going to come quickly, because if it does, then we will have bigger problems at hand, not just dealing with one NBFC or one bank.
All right. What do you make of IT as we head into the new? I just want to talk about it a little bit because market seems to be jaded or ignoring any news that comes out of Infosys, for example. We had a brief respite in some of the tech stocks towards the end of the year, some amount of a pickup coming in there. But do you really see it playing out as a theme led by the likes of a TCS, or do you actually see some of the mid-cap names actually providing further potential going forward?
No, mid-cap IT, you can always find that one isolated bet and make money. But the real game for the IT was when the growth has come back to 8%, 9%. And plus, these guys, they didn't innovate enough. And I think the price was going up because of the buyback thing. That has again been punctured by what the government did, by imposing a buyback tax. So that's impacted the IT company. And if you see, post-July last year, post the budget, the IT names aren't doing the way they were supposed to do. So I think that's one event there. And IT is good for a pensioner. You want 8, 10%, you want a dollar-denominated return in your portfolio, you're fine with an IT stock. But if you're young and raring to go,
so from the traditional defenses, let's keep IT aside, let's talk about pharma. Different story there, of course, various factors at play. But even if you were to be stock specific, because we've been hearing a lot of positive commentary coming in on pharma as a theme that may play out going forward. Again, defined to perhaps, select stocks. Would that be on your radar if you were to have to add something to the basket?
No, again, the same thing like in IT, isolated pharma company could do well, but broadly, I mean, there's too much of a headwind around.
Okay.
Basant, you were talking about the compounders and classic cases being HDFC Bank. In the next decade, as we move on, will they continue to generate those kind of returns? We've seen some new listed entrants as well in the last decade, if I were to, mark that. A DMart, for instance. People talked about the valuation that it listed at, it traded at, but just look at it. You're still sitting on sizable returns if you even bought it the day of the listing. What happens to cases like these? What could challenge their growth?
Yeah. So it's not a recommendation.
Sure.
A small bank, for example.
And I would add Bajaj Finance also to this pool.
So a small bank like say an AU Small Finance Bank, exorbitantly expensive. We don't own it. But at some point over the next 5 years, we have our eye on this stock that we would like to have it as part of the portfolio. In 2001, HDFC Bank, if I recall, traded at a price to book of 7 times when it bought over Times Bank and merged itself with HDFC Bank. From there, the stock has gone up 50x. So it's not that if a stock trade at 7 times book, you cannot make money out of it. But I think the time over the next 4, 5, 7, 10 years is of a few companies doing well. The narrative has changed from small is beautiful to big is great. And that's globally, like the FANG stocks, the BAT, the Baidu, Alibabas, they control 8% of global market GDP. So in this era of globalization and opening up, I mean, the big boys will have all the pizza for themselves and the small ones will only get a few toppings here and there.
Sure. So no concern really when it comes to DMart, Bajaj Finance, this whole theme that was, or rather scare in the market that, quality is in a bubble, you completely dismiss that view.
No, I think who am I to decide whether it's a bubble or not? Like if somebody says there's no value, I said, who are you to decide if there's value or not? The value reflects itself on the screen. If the stock is being manipulated, it can be manipulated for a day, for a week, for a month. You cannot have a manipulation running for 2, 3, 4, 5 years. So about not going specific, but as long as growth is there, the party will continue. It's like the music at the late night party. As long as the music runs, you can't stop people from standing up and dancing.
Seems like you suffered last night when you were trying to sleep.
This is a famous comment from Chuck Prince of Citibank. He said, I'll continue to dance as long as music is on.
The music plays.
The problem is he never figured out when the music stopped. And then 2008 happened. So I'm not getting into music and party, but I'll get into something which in a sense has, let me give you an example. I met somebody, he said, look, I will buy mega trends. Pretty much like your thought, that I'm going to buy these good compounders. I bought a Titan in the past, I bought a Bata in the past, I bought a Trent in the past. I'll continue to buy them because these are mega trends for next 10 years. Then I met another fine gentleman 3 days ago. He said, look, mean reversion is the biggest truism. What has worked in last 10 years may not work in 10 years. Markets will always mean revert. That is how it's happened. Where do you think that the outperformance will continue? And where do you think there is a serious scope for mean reversion?
Nikunj, I think predicting trends is a loser's game. If you see a trend, change your trend and get into it. don't try and anticipate it, because these mega trends, they may defer itself for 3-4 years also. Like since 1995, there was this chatter of the US economy crashing. It crashed in 2008. And the crash was held back because of the internet innovation, because that created so much of productivity around that the US did not crash for 13 years. So I would suggest, because that's what we do normally, is not go and predict a new trend, but when you see a new trend, you jump into it, and it takes you 3 days to change trends.
Are you seeing any new trends emerge?
No, but all the trends, we don't get to participate. They're all in the private equity domain.
So how are you investing in this environment where you know that there's a lot of liquidity and very few stocks, and very few stocks will continue to surprise you? In this slowdown also, Bajaj Finance has done well. HUL has given you volume growth. Imami is not giving you volume growth, but ITC is giving you volume growth. Edelweiss is not growing, but Bajaj Finance is growing. Infotech Enterprises is not growing, but TCS is growing at double digit. Disruption has happened everywhere, and large cap companies, because of disruption, are gaining market share. The problem, Basant, is that how much of this thesis is being played out? Because I'm not saying it. People on the street, they say that ultimately investing is about buying gold at the price of silver, not buying gold at the price of diamond.
No, you buy gold at the price of silver is great, but if the gold that you have bought and you think is actually gold turns out to be actually silver, then you haven't got a great deal. So that's what happened with all this. You need a catalyst for the valuation to change. And there are several catalysts: a dividend, a stake sale, sale of land. But the biggest catalyst is growth. And growth is a recurring catalyst. It's not a one-time catalyst. It comes around year after year, year after year. So as long as the growth continues, I don't think any trend would change. But when the growth when the growth stops, then you have to sell out and move out.
So I'll give you a very simple anecdotal data, which is that let's look at interest rates. Interest rates, they act like gravity. Interest rates, they go higher, profits come down. Last 10 years, one thing which has definitely happened is that interest rates have come down from about 5% plus in US to sub 2%. Interest rate, we've reached an era of negative interest rates. For next 10 years, interest rates cannot come down more. If interest rates, they start gradually inching higher, if global growth comes back, we are looking at an inflationary scenario. I'm talking macros here. But for me, that could be a risk to a thesis which could challenge equity as an asset class, because last 10 years have been good for India. And I've always seen that every time flows move away from India, we may be great, good, we may be having fantastic companies. Because of the structural nature of economy, stock prices, they suffer. How does one deal with these imponderables which are staring on us, and they are trends which will decide the way our returns would move in the next 5-7 years?
So 3 things. First, if interest rates go up, there will be a global collapse. There is so much of debt riding on that interest rates that the US government cannot afford to have its interest rates go back to 4%, 5%. There has to be a global collapse. So whether you have an HDFC bank or you have a Yes Bank punting from 40 to 60, we are all going to lose money. Second thing, globally, the theory is that the PE ratio is the inverse of the interest rates. Yeah. So if interest rates is 5, 100 by 5, the 20 should be the PE. If interest rates is 1, the 100 by 1, 100 should be the PE. What is the PE if the interest rate is negative? I don't know. So stocks and interest rates, they move relatively inversely to each other. And the third part to this is, let's not preempt it. If the interest rates go up, we'll all see what to do. Because my theory is, if interest rates go up, why are interest rates going negative? And why? I read that in Denmark, you can buy a home loan at negative interest rates. So you pay less than what you borrow from a bank over the 20-year period. Why?
Also, I think.
Yes. Why? Because there the asset prices are supposed to deflate. So 1 million home would be worth $900,000 only after 10 years. That's why you get a negative interest rates on home loans. So everything has a reason in this world, and I think that's the way to look at it.
Okay. Okay, exciting. Any risks that you have on you've sounded very positive this entire morning, which is what we like to hear on the 1st of January. But while things seemed calm and cheerful at the end of the year, we're still assuming we'll hear something in the budget. We're still always on the verge of geopolitical risks as well, whether it be globally, elections, whether it be for Trump, back home, we're also seeing the political environment. To you, what are some of the major risks?
I think Trump will sort everything out. He'll leave something for the next elections. Okay. So that's all a fixed match if you ask me.
Okay.
The biggest risk, if the company is great, is of regulation. I hope the government doesn't do anything extraordinary in trying to get something more out of the public. So if the government can give us some hope, some help, and can address to the basic issues of the stock market, I think we'll be fine. But as a stock market guy, risks are always there and it keeps you awake at night. But it's not too much if you're holding those 40, 50, 60 companies that are doing well. But the biggest risk that most people would normally line themselves up is to try and figure out, can I buy this small cap, this turnaround, which will turn around after 2 years when something else happens? So this is not the time to be taking contingent bets on 200 different variables. This is a time to be playing straight and through the V, as they say in cricket.
Basant, what have been the learnings from the year, 2 years gone by as we step into another new year and decade? Because, post the IL&FS DHFL crisis, what one saw was a complete collapse in real estate and thereby the ancillaries as well. Your HFCs and a lot of other segments of the economy as well suffered and continue to do so. Where is it that you would be like a little wary to now invest into or even gauge for that matter?
So the biggest learning which just got reinforced for us was never buy the poor cousin. Always buy the big brother. Because the poor cousins in every sector have got
issues.
For example, in jewelry retailing, you just have one company surviving. In aviation, you have one. In NBFC, you have 3 or 4. So most of the companies, in cement also, the bottom rung trade at $100, $120 EV to EBITDA, and the top ones are still going at $250 EV to EBITDA. So, for example, not a recommendation again. A Shri Cement does a QIP at this price, picks up the money. Now it's got the cash when somebody else wants to sell. So, if you are with the leader, I think you will still survive to tell a story, and you'll still survive to retain what you've put into the market. But trying to be over smart just to make that extra buck, don't buy the poor cousin.
Let's talk about a stock which in a sense is puzzling me personally, HDFC Limited. It's got everything going for itself. The entire HFC space has got disrupted. It's survived. It has survived another stormy cycle. It has gained market share. The NIMs are absolutely perfect. The baby companies are now taking a birth. There's one or two baby companies of HDFC Limited which will be listed hopefully very soon. Why is HDFC Limited? I don't know if you own it also. Why is HDFC Limited trading at such a deep discount? Why it has become a ranked underperformer? It's the largest in the HFC space where disruption has happened. Everybody else has gained, but HDFC Limited is languishing.
No, we don't own it, but I think the biggest thing what comes to our mind when we look at an HDFC Limited is it grows at only 15-16%. It's got an HDFC Bank which outperforms HDFC Limited, but it's got only 22% of HDFC Bank, so it cannot consolidate earnings. It's got an HDFC AMC, but HDFC AMC is a small company with free cash. HDFC Limited needs all the cash to reinvest into its business. So AMC is going out for another reason. So most of the subsidiaries that are built around HDFC Limited have their own unique ways of not trying. So HDFC Limited is like the grandfather at home. And these are all the children who go around partying, having a nice dinner and come back home, and the grandfather eats good food and is still happy with what he's doing. But still he can't be as active as the children.
But Buffett is still the grandfather, the third richest man.
HDFC Limited has been built on the same lines like Berkshire Hathaway.
Exactly.
25 years back, Berkshire used to own a bank, and because of some regulatory reason, it had to dispose it off. So I think Mr. Deepak Parekh had that foresight to try and do a Berkshire Hathaway in India, and HDFC Limited was the only thing. The difference is Berkshire Hathaway's operating subsidiaries aren't listed. Here, HDFC Limited has listed its operating subsidiaries.
And
Berkshire has
will continue
also
to
bought
do so.
into a furniture company.
Yeah.
They've all bought into a lot
Too
of
much
other companies.
diversification, jewelry.
Yeah, I mean, he
But it's a
understands
one
what he
store.
likes.
Jewelry is a one store. Wash it.
The biggest investment in a sense now last year, what they revealed was actually Apple. And before that, the Burlington Roads Railway has done very well for themselves.
And they were so late in the game to invest in
But
Apple.
one point, Nikunj, talking of Buffett, we always say he made an 18% CAGR since inception. But if you remove the float, I don't think their CAGR is even 8%.
No, see, Berkshire Hathaway stock in last 10 years has been a massive underperformer. Since we're talking about Berkshire Hathaway here, and let's be very clear here, I mean, with all the due respect we have for Warren Buffett, and who are we in this room to comment on him, you're sitting on $100 billion cash. You were the same guy who in a sense said, look, I don't understand Amazon, I don't like Google, these are technology companies where I don't have an understanding. You bought into IBM, you got out of IBM, you're appreciating these companies when they've become $1 trillion companies. With all due respect, I mean, Bill Gates is his best friend, and he said, look, I've never invested in Microsoft. So has Buffett missed out on what has been the best of American tech? Because last 10 years has been all about the tech and the birth of tech giants, which have made the American economy really make a
No,
comeback.
with somebody else's money, he cannot take risky bets because float is somebody else's money. It's the insurance guys who are paying you up front.
Yeah.
So that's why he looks for longevity. And Buffett, he says derivatives shouldn't be done, but he's written the largest amount of puts on American markets. So he's a great businessman, I would say. Better businessman than an investor. Not that he's a lesser investor in an absolute sense, but he's a great businessman.
If a client walks up to you after this interview, say, Basant, very impressive interview. I like the questions what Aisha and Nikunjan asked you. I liked your answers also. I'm happy to invest with you for next 5 years. I will ask you no questions, but after 5 years, I will ask you that how have you managed to beat the market? What would you buy in that portfolio?
First, I'll say thank you to all three of you. And then we'd buy the same things for him, what we buy for ourselves. We wouldn't do anything different. Allocations would change. A new stock would come in because you can't buy the same allocation at the present price. But broadly, the theme, the 60-70% theme would remain the
So
same.
I'll put this out maybe once after the interview is over on the Twitter and I promise on television channel. We'll call it Basant Maheshwari's bulletproof portfolio for this decade. Let's talk about it. You may pick sectors, you may pick themes, you may pick stocks. But if I say, Basant, here's the blackboard, I'm going to write the headline, you will fill in the colors. And the headline is Basant Maheshwari's bulletproof portfolio for this decade. I'm giving you 10 years. 10 years is a long time for a classic investor like yours. Why don't you fill in the colors?
Top two stocks in the consumer and the retail, in the consumer finance, in the consumer and the financing space.
Top two stocks in the consumer finance and the consumer retail.
Yeah. So within the consumer finance, within the consumers, within the finance, you will have different segments. You might have an AMC, you might have an insurance, you might have a private bank, you might have an NBFC, but don't go beyond the top two.
What else?
That's it.
Just two stocks.
So you will get 4 segments. 4 into 2 is 8. That's too much to make a
8
life out.
stocks you're happy with.
Yeah.
Okay. My next question to you is that there is always quest in the market to identify multi-baggers. Right? That's what investors, they always desire for. Which could be the next multi-bagger. And in last decade also has given you multi-baggers, whether it has been a Havells, it's been a Quest Corp, it's been a Vinity Organics, it's been a Shree Cement. Where do you think there is scope of massive re-rating? Where do you think the earnings, the potential of earnings, NP expansion is going to be very large? Where do you think there is this earning power which is about to unleash, which you've noticed, where you're confident of and markets are not recognizing that?
So there are 2 drivers to a multi-bagger. The first is the earnings growth and the next is the PE expansion. You might say that a 40 PE is too much. It wouldn't expand. But if you go and backtest the history, iShare Motor, Page, Sun Pharma, all these companies, every year the valuation expanded 8 to 10%. So each incremental year of growth adds more to the valuation game. So if a company is growing at 30%, the valuation expands at 10% more. So you get a more than 30% return on your stock. So it's okay to say, I want to buy a 40% grower at 10 PE, but even if you get a 40% grower at a 40 PE and it grows at 40% for the next 5 years, the PE ratio at the end of the 5th year wouldn't be 40, it would have upgraded itself to 70 or 80 or 90, and that's where money is made. So you don't have to buy cheap and sell expensive or exorbitantly expensive. You can buy expensive, and as long as the growth continues, the expensive would naturally become exorbitantly expensive.
Okay.
You know, I must say, Basant, when I started interacting with you first, I was slightly cynical about the way you were investing because you were buying some of these expensive stocks. But the learning for me in last couple of years has been, just because a stock has become 3x or 5x in last 10 years, it does not mean that it cannot become another 5x in the next 10 years. You know, like they famously say, it's like the folk story on Dalal Street. If you speak to some of the old timers, they say there is a reason why houses in Pedder Road, they trade at a premium, and houses outside Pedder Road, they trade at a discount. Good quality businesses will trade at a premium. I mean, that is what we've realized. I mean, or you need a scary situation like 2008 where serious price dislocation happens and you're able to get bargains at the price you want. The whole endeavor, what classic fund managers I have in India, buy a stock at a P of 15 with a growth of 30% and when the return ratios are more than 20%. That's not going to happen at a Nifty of 12,000, let me assure you.
And with interest rates at 0 and negative.
Okay, Basant, always great having you in the studios, and we hope that 2020 and beyond is as prosperous for all of us. Thank you so much.